First rates Tuesday morning, any seconds on your screen now, and the first rates are going to be, let's wait for it. The first rates are 48 points higher for the Nifty, the market breadth near perfect. There is strong uptrend which continues in Adani group of stocks. After yesterday's strong session, the uptrend in Adani group of stocks, it continues. You got Uptick, which is clearly visible in IT, which is that IT stocks are picking it up from where they left yesterday. You got BPCL is looking strong. I think the Morgan report on BPCL. And then you got MCX, where numbers were not that great, but brokerages feel that give it that the margin of safety now for a stock like MCX is well in the price. But I want to look at PB Fintech. There you go. MCX not surprised at all. PB Fintech, 21 rupees higher. The same stock had got punctured, and there was extreme fear at the beginning of the year when anchor investors were selling, and they were selling as if there was no tomorrow. It came below 400. Now from 400, sub 400 to 650, it's just been a V-shaped recovery for PB Fintech.
Yeah, PB Fintech definitely on our radar this morning. That really is one of the stocks. There's also Vedanta. Remember, the board has approved the first interim dividend for the fiscal at 18.5 rupees per share. Vedanta as well starts off in the green, 1% higher there. JSW Steel, NCLT has approved the resolution plan of JSW Steel coated products for NSAIL, so look out for that stock as well. Indiabulls Housing as well, the AUMs have come up by about almost 4% on a year-on-year basis, and the gross NPAs are now at a 6-quarter low, although you're not seeing any marked recovery in the stock price as of now. There are of course a lot of earnings. There's SJVN, there's Garware Technologies, etc., which have also come out with some decent set of numbers. On the weak side, though, there's Shree Cement. The margins, EBITDA, they're all below what the street was anticipating. Shree Cement, though, starts off a little bit tempered and in the green as we speak right now. Barmalori, they're going to be mulling a buyback. That stock has jumped up this morning and it's gapped up about almost 5%. 131 is where that stock is. Negative earnings then from HEG, Gujarat Alkalis, Finolex Industries, Borosil, Dhanlakshmi Bank, where the NII is down 9.25%, operating profits have slipped 29%. These are all a weak bag of earnings, which are largely reacting to their numbers right now. Let me just refresh the screen and show you where the Adani group of stocks are and what IT as a pack is up to and whether that trend continues or not. Adani Enterprises, 10% gap up this morning as well. Adani Ports higher by 4%. Let's bring up Wilmar. Let's bring up Ambuja. Transmission higher by about 5%. So that strength in the Adani group of names continues this morning as well. BPCL, Cummins and MCX, that's holding up 3.5% as we speak right now. That is the other stock. Remember, it's down about 19% from its year-to-date peak. The biggest concern, of course, was the delayed transition to TCS software. For every quarter of delay, remember, the company pays an additional 81 crore rupees. However, the volume growth remains strong for MCX, and that's gapped up 5.5% as we speak right now. Let's check in on Max Healthcare as well, considering GQG Partners has bought about 7.5 million shares at 550 rupees. Max starts off with a gain of about 1.5%. What's Nifty IT up to? I can see Infosys actually hold out, as is Wipro. But of course, the move on IT is a lot more tempered as opposed to what the move was yesterday, at least. But Kunal, where do you think one can punch in trades here?
I think it's a good start for the indices. We are back almost at 18,380, 400 on the spot Nifty. So that would probably encourage more, long rollovers for the indices in the next series. So, since we start off the expiry week, so I think that's also going to be an encouraging point to look out for. PSU banking stocks are making a mild comeback. So the stock which I would look to trade in the open would be on Canara Bank. Very interesting chart, formed a bullish hammer pattern 2 days back, recovered above the 300 levels. Looks very attractive on the short-term basis. So that's a stock which I would be looking to recommend to clients as well.
Okay, that's Canara Bank for you. Let's also find out what exactly Naresh is punching in as his first trade. Naresh, what is it that you're looking at, given the screen is looking healthy at around 18,380?
So looking at a bounce in L&T at 2215, 2220 looks interesting for a bounce towards at least 2300 in the short term. So L&T is a trade where risk reward fits in really well.
other buzzers there. While, of course, the Adani group of names are the ones which are a buzz. Adani Enterprises up 10%, Adani Ports holding higher by 4%, Ambuja is up a good 2% as we speak right now. There's also Cummins, which is holding out almost about 2% in trade, and then MCX, which is scaled up very smartly, 5.5% higher as we speak right now. Not such a great performance from an Indiabulls Housing. Dixon, in fact, we discussed this stock with Kunal earlier today. That's actually taking a breather. It's down about 1.25%. Lalpat Labs, Balrampur Chini, Manappuram are all seeing red ticks for themselves. Dr. Lal currently lower by about 1.5%. Balrampur Chini and Dixon is the other one, along with Manappuram, which is going to come up for you on your screens. These are all the red starters. For the index, about 50 points higher is where we're currently at. Let's see which way we head from here. Kunal, shouldn't be a problem, I guess, to, get back into that new high zone, which we did till about last week and then took a step back.
Yeah, so I think 18,400 should be taken out, say in the next couple of days, and especially going to the Thursday, monthly expiry, because the markets would want to end up this the second straight consecutive month of bullish sentiment on an optimistic note. So I think in that regards, we would probably see the index closing near to the high point of the day. So wouldn't be surprised, high point of the the series. So wouldn't be surprised that hopefully by Thursday we break past about the 18,400, 450 mark on the spot Nifty. And I think what I like about the markets in the last couple of days specifically is the new set of sectors making a comeback. That makes the market internals a lot more vibrant than what we have seen over the last maybe 1 or 2 months.
All right, that's the view coming in from Kunal. Meantime, Naresh, what about your take on BPCL in trade?
So still not a convincing stock as such. We've seen a decent enough recovery for the stock, but from here on, I would be a little more cautious on the stock. Crude is at the lower end of the range. We are not seeing a similar, say, crack which could have come on the other side. So would avoid the whole space as of now. So say if we get closer to 330 to 350 mark, that's the time where you want to get into the stock, not at current levels.
We'll see you again later in the show, but here's a word coming in from Sunil Singhania from Abacus as to where he's making, where the market is going to be headed from here and what is his overall market analysis.
So, I think one thing we have to remember is that earlier, we used to have a 15-20% move in the market once in 2-3 years. I think we are in a zone where we'll have a 15% move in the market 2-3 times a year. And I think that is the reason you are seeing this bouts of, markets going down and coming up from time to time. The world is very correlated. I think markets are taking a cue from each other, and therefore you are seeing this sharp moves up and down. On the other hand, I think you are right. The things seem to be stabilizing in the world. Our view on oil has always been of a softer oil, and we still continue to believe that oil will settle more like $60-65 than where it was. It's already down to 70. The world also has started to believe that inflation has seen its peak, and as a consequence of that, interest rate has also seen a peak. And on the other hand, you also have cost pressure which companies were facing because of raw material moves and freight moves and also energy costs. They are also stabilizing. And on the fourth side, you have China, which had a very strict COVID policy sort of reopening, and there is an optimism that there will be some growth there. So the world in 2023 second half should be much better than what it was in the last 1 year. And maybe that is a reflection which the markets are basically showing us. As far as India is concerned, result season has been pretty good. Obviously the very obvious sector, which was the financials, has done much more and much better than what was expected. And other sectors have performed in line or better than the muted expectations which the street generally had. And as we move forward, again, the optimism is that with interest rates coming off, so 10-year yields in India are down below 7%. Inflation has hit a significant low post the Russia-Ukraine issue even in India.
Well, if there's one interaction I always look forward to, and our viewers also look forward to, both in terms of learning, understanding, and perhaps deciphering what is the way forward for markets, economy, risk-reward ratio, and the discipline in life, is Prashant Jain. To understand his view on markets, to understand his thoughts on value investing, and to understand that how life has changed for Mr. Jain in his new avatar. So let's discuss all that and much more with Prashant Jain on this edition of Market Maker. So nice to have you back. Thank you for joining us.
Good morning. My pleasure.
Almost a year.
Yes.
Almost
yes,
a year.
Yes,
I think
yes.
July is when you decided to start your entrepreneurship journey.
Yeah.
So far, so good?
So all well, Nikul. We have done well so far.
As per your expectations, or?
Yes. No, I think we are on track. By and large, it's been smooth. We have been lucky. We are off to a good start.
So was it, do you regret the decision, or are you happy that you finally took that plunge a year ago?
No, I think it has turned out to be good. So I had a great stint there, and I have very good relations with everyone in the team, great respect for that organization. But I think they have done exceedingly well. The transition was extremely smooth. And so I think it's been good for everyone.
Good is the word I can use to define the markets also, right? It's been a good comeback by the bulls. I mean, just when it appeared that things were looking puffy-duffy, globally inflation scare was there, interest rates were not coming down, bulls have made an impressive comeback.
So I think yes, if you look at markets, last 18 months have been flat. They've been range bound. And that has led to, the time correction has led to moderation in multiples. And even globally, interest rates seem to have peaked, at least for the time being. I mean, I'm not an expert on that. So I do think that the risks have slowly got addressed. Valuations have turned reasonable. So I would say these are fairly valued markets. But still, I would say there is not much room for multiples to go up, at least in aggregate terms. So I would say broadly, returns should track earnings growth or nominal GDP growth.
When you're saying valuations are looking reasonable, I'm assuming that you are looking at historical benchmarks?
Yes, if you look at, in terms of PE multiples, typically I think 1 to 2 years forward. So in 3 months' time, we'll all start focusing on fiscal 25. So I think based on fiscal 25, markets are trading between 16, 17 times, which is reasonable. Which is not cheap, but it is not unreasonable either. I would say things are just about okay.
Is it a good idea to look at historical benchmark, because history and these conditions, when these P multiples were there in the past, the conditions were very different. Liquidity, underlying growth of the economy, global interest rates. So is it a good idea to look at historical benchmarks and talk about valuations?
So when I look at historical benchmarks, I look at typically a 15-year average, because that does cover 1.5, 2 cycles. And if you look at 15-year averages, I think we are slightly above that. Our growth rate should improve hopefully as we go over the next few years. I think India is acquiring more and more prominence, visibility globally. It's becoming a large, fast-growing economy. Geopolitically, I think we are in a good situation. We are a good boy in the world. So I think given all of that, the size, the growth, I think a 16, 17 P to my mind appears to be reasonable. And it is also in line with slightly longer term averages, maybe slightly higher.
I'd like to draw your attention to what's happening to flows. For FY20, for 2022, foreign institutional investors were big sellers. For the calendar year also, they've been net sellers. Now that we are the official big boy or the good boy in the world, what are the chances that this year flows could reverse, and in that the market P multiples actually could surprise us on the upside?
So Nikunj, that's about the only uncertainty that one is, if one is forced to mention. I think that continues to be a risk. But let us look at it the other way. When foreigners sold almost 40 billion worth of stock between, I think, September 21 to June 22, the markets held pretty firm. So I think the local flow of savings towards equities has changed decisively, and people like you have played an important role in that. So I think the vulnerability of the markets, at least from a medium-term perspective, to foreign flows would be far less, I feel. But that possibility can never be denied completely, because globally, inflation thus far has not come down as much as markets would have hoped. and some people talk of a recession. I don't think that impacts the economy in India, but it could impact the markets short term. But I would look upon that, should a correction happen induced by foreign flows, I would look upon that as an opportunity to buy an otherwise a very strong fundamental story.
Could the reverse be at play? That foreign institutional investors, yes, they've been sellers, then they continue to sell, but last 10-15 days the tide has turned, and now FOMO actually could hit them, which is that they could be forced to make a comeback.
So I think if you think slightly ahead, if you think 3-5 years, I think India could emerge, could enjoy larger allocation in the scheme of things for foreign investors. Because if you look at the EM basket, I think India is probably one of the best placed economies, countries in the EM basket. And I think therefore over time we should continue to attract bigger flows. So I would not, whether it is FOMO or whether it is whatever, but I think look at India, it's a 3.5-4 trillion economy growing at 6-7-8%, and it ticks almost all the boxes. So I would say that anyone with a medium to long term perspective would want to be not overweight India. I mean, they would want to be overweight India.
You've been a big advocatory of banks, and especially banks, big banks and banks which have a strong CASA and a big balance sheet. Now that trade has worked like a charm now. What was more like a consensus view has now become a consensus trade, which is overweight financials. But do you think even though it's a consensus view and a consensus trade, the consensus prices has not reached there?
So I think, yes, most people agree now that, and the stock prices have moved sharply. So most people agree that banks are in a sweet spot. Balance sheets are very clean. Credit growth is reasonable, and profitability is holding up well. So I would say these banks should continue to do well, and the gap in valuations across banks, the earlier what we used to call the retail banks and the corporate banks, that has now converged, and actually that divide is becoming less relevant now, because the asset side of almost all the large banks is increasingly looking similar to each other. So I think the re-rating part of the trade has played out to my mind, but this represents a sustained growth business. So I think one should be able to make returns in line with the earnings growth, and banks I think should grow their earnings medium term slightly ahead than the Nifty. So to that extent I think there is still room for some outperformance there.
Who has the right to win in the financials?
My vote would be for the large big brands that have scale, that have good technology platforms, that have a good CASA mix, and so my vote would be for, I mean that's an obvious one, and there could also be other smaller niche companies which can do extremely well, like some small banks are doing quite well. But this clearly is the biggest piece where I think the outlook is quite decent.
You started buying into State Bank of India when they reported a record loss like never before, I think 6-7 years ago. For the quarter gone by and for the year gone by, they've reported a profit which is at a record number and the second highest in the history of any corporate. What is the trajectory for, let's say, a bank like State Bank of India or ICICI Bank, and what makes you so bullish?
In fact, I used to discuss with many people that State Bank will do more than 50,000 crores profits, and they used to joke, but then they texted me back, look, you were right. So I think the bank has done extremely well, and other than one product category maybe or two, they have actually not lost a share in any of the products. So I think it's a really well managed bank. The technology platform is extremely good, and with every few years they improve. Like So I think it's a future fit bank. They should continue to do quite well. And as I said, large banks that have good technology platforms, think of it this way: when you enter the world of digital banking, a large bank is in a great position to write a very small loan or to write a loan in a remote location also, because it is technology that is working for you. So I think the current digital banking environment, the digital environment, it favors the large banks immensely. The limitations of physical space and resources is gone, and they are best placed to leverage this environment to my mind.
You know, when I just recall some of our conversations, and it is absolutely amazing that what we've discussed 2 years ago, 3 years ago, markets are recognizing them. And one theme which you've liked in your previous avatar was defense manufacturing. These stocks are commanding P multiples of consumer stocks now. Do you think from a market standpoint, this entire defense manufacturing or railways manufacturing has been played out?
I think again, in terms of the multiples moving up, they have played out. See, 2 years back, these stocks were between 5 to 7 multiples. And today, they are anywhere between 20 to 25 multiples. So I think the multiples re-rating has happened, but these are highly sustainable businesses. They have many growth tailwinds, both support of government, focus on indigenization. And I think the Ukraine war has also highlighted that you need to maintain large inventories of ammunition, because what you produce in a year can get consumed in a matter of days. And I think India also offers you competitive pricing for the technology what we deliver globally. I think the exports opportunity is also there, though it is smaller compared to the domestic opportunity. So I think again, coming back, it's in a similar position as the banks. The re-rating has happened, multiples are fair, but you can make some money as the earnings or the business continues to grow.
But Mr. Jain, if I look at, let's say, an HAL or BEL, or for that matter, Kochi Shipyard, the order books are strong. But again, I just want to remind our viewers that ultimately to execute these order books, it could take 3 years or 4 years to build an aircraft. It could take 5 to 7 years to build a Navy ship. So right now, yes, these businesses are growing purely on basis of order book, but eventually these are long cycle businesses. So how does one go about investing in them?
No, you are absolutely right. So I don't think these are rapid growth businesses. The order backlogs are very large, could be 5-7 years of turnover also. But the way this business works, I mean, you are absolutely right. To build an aircraft, or you have a number of aircrafts on order and you will deliver a certain number per year. So these order book will get exhausted over the next 5 to 10 years. That's why I said, I mean, these are businesses that can, but they should still grow. I think between 10 to 15% a year they can grow. And if you add back the dividend yields, that will become a reasonable return. But I would agree, by and large, that the scope for further re-rating is not there.
So what, to your mind, is at the threshold of getting re-rated? Whether it happens this quarter or next quarter, that no one knows. But do you think there is a significant scope for that business or sector to get re-rated?
So I think one space which has also got re-rated, but I think there could be still some scope for it to get re-rated is the power sector. Because go back 2 years and ESG was a very live theme. And the world thought that you can transition from conventional to new energy overnight. And we have discussed this number of time, that was not a very realistic view. But I think people have come around to that view, that conventional power is here to stay. And world over you are seeing what is happening in the power space. Even in India, it is now possible shortages of coal or power that make the headlines. And recently, I think there were some reports that we are likely to announce fairly large new conventional power plants. So I think India's, as I have always said, India's per capita power consumption is extremely low, and power represents a growth business in India. And also, I think some of the incumbent companies, their quasi-sovereign status gives them a significant advantage when it comes to borrowing. And whether it is in conventional or in renewable power, the cost of borrowing is the biggest delta between two businesses. So I think the widening of spreads globally and even in India to some extent, I think has enhanced that competitive advantage. So I think these utilities are still not trading like growing businesses. So I think there is still some room for re-rating to take place there. But by and large, I feel there is not much scope in this market, to my mind, for multiples to go up in many places.
Which means if you are of the view that markets will grow in line with earning estimates, let me ask you that what are your assumptions for earnings growth for next 2-3 years?
I think, Nikunj, our profits have recovered strongly. India's profits to GDP had fallen to under 1.5% 2 years back. And that was due to NPAs, low commodity prices, weak capex. So we have what we lost in 5-7 years, we have recovered in 2 years. So today our profits to GDP is almost back to 4.5 to 5%. Whether it is banks, commodities, capex companies, consumer, IT, pharmaceuticals, chemicals, metals, utilities, almost everyone is making decent money. So I would say there are very few places where margins or profits can grow faster than top line growth. So I would say a 12 to 14% profit growth is what appears to be sustainable, not more than that to my mind. So unless India's growth rates move up.
So 12 to 13% or 12 to 15% compounding return for equity as an asset class for 3 to 5 years should be a reasonable expectation.
I think, yes, 12% is a very realistic. I think could be slightly more also. I think what is exciting is that India's real growth, which has averaged roughly 6% for last 2 decades, I think that could move to 7-8%. Because what has happened, India has gained competitiveness in manufacturing. India's wage inflation in Asia has been one of the lowest last 10 years. So because we have not done well in manufacturing, if you look at Vietnam, Indonesia, their wages were less than half of India 10 years back. Today they are slightly higher. So because we have not done well in manufacturing, we have gained competitiveness due to lower wages in manufacturing. And apart from that, the large global corporations want to de-risk their supply chain from over-dependence on a single country. And also because of geopolitical reasons post-Ukraine, India is a favored destination. So I think India's time in manufacturing is finally coming. And manufacturing is a much bigger opportunity than services. So just 0.5% of global manufactured exports, just 0.5%, is 4% of India's GDP, which is roughly the same size as software exports out of India. So I think India's growth rates of 6-odd%, I think current decade and next, I think we should be able to grow between 7 to 8%. And should that happen, then of course there is slightly higher room for equities to grow.
So let's spend some time on manufacturing, because I think from 2019 onwards you've been using the word electronic manufacturing. Nobody ever thought that India could be a net exporter of mobile phones, but you saw that coming, and today we are a net exporter of mobile phones. Defense and railways are government-backed manufacturing. You're trying to create a moat by putting import duties and incentivizing them with PLI schemes. But the real proof of the pudding would be when we are exporting to the world. Which categories of manufacturing do you think in India can really fill that gap where we can be the factory to the world?
So I think we have a very big opportunity because we have land, labor, power, technical skills, supportive government, entrepreneurs. In barring the electronics space, where we are yet to create an ecosystem, and we are essentially assemblers right now. But I think barring that, our ecosystem is also reasonably well developed. So I would say whether it is textiles, whether it is engineering goods, whether it is chemicals, pharmaceuticals, in all these spaces, whether it is automobiles. Look at what Mr. Bhargava said recently. Yes. He said new plant dedicated towards exports. In two-wheelers we have done extremely well. So I think all spaces of manufacturing by and large, other than electronics, I think we have reasonable capability and we should do quite well, and we are moving in that direction. I think in the electronics you need government support because we lack scale, we lack expertise, and we don't have a ecosystem. So right now you are starting from the finished product, you are assembling the components, and slowly I think we will work backwards as more and more capital goes in that space, whether it is driven by local entrepreneurs or by global companies. And government also is extremely keen on developing that ecosystem. But I think other than that space, we are reasonably placed today also. And in that space, we have a lot of work to be done.
So let me try and divide your thoughts into categories: cyclical, structural, and value. I think banks will qualify as something which is the structural part of your portfolio. You've been owning banks and you will continue to own banks. We've discussed that. Now let's understand the cyclical part, which is that, Prashant Jain is known for buying out of fashion stocks. You've not shied away from buying IT at a decline or pharma when they were out of fashion. What is the cyclical bet in your portfolio, and where do you think there opportunity is there?
So Nikunj, this is a unique market, and in my career over 3 decades, there was some sector or the other which was always offering good value, where you could make money not just on growth but also on multiples going up. But first time I am facing an environment where I don't see meaningful scope for multiples to go up in almost any sector. So I think this is a phase of the market. Something will change over time. Some opportunities will emerge. But in this market, profitability is optimal. Valuations are quite optimal. Some sectors which are very expensive, let's say IT, they have derated significantly. Only the consumer space is still one sector where I think the multiples could derate even more. The derating has not been enough. But other than that place where potentially multiples could go down.
That's an interesting conversation underway with Prashant Jain saying that banks are a space that will continue to perform well. Defense, though, he believes that, as of now, there's not rapid growth expected within that space, but manufacturing is a huge opportunity versus services. A quick check-in as to what the index is up to: 18,400 as a print on the screen, with the Sensex up 200 points and the broader markets holding out by 0.5%. All right, let's shift gears then. It's a blistering heat wave that is scorching India. The temperatures in New Delhi have touched 46 degrees, and there is also the IMD talking about heat waves in several states. What does all of this mean when it comes to demand trends for companies like Vijay Sales and Symphony? We've got Nilesh Gupta, Managing Director, Vijay Sales, as well as Amit Kumar, ED and Group CEO at Symphony, joining in. Thank you so much, gentlemen, for taking time out. Clearly, it's the sweltering heat that's taken over the country. And Mr. Gupta, I just want to get in a sense from you as to, has this really bolstered demand when it comes to AC sales, and what kind of growth have you witnessed over the past few months?
So, good morning, everybody. So, what we have seen is we did not have a great, we had a very great start in the month of February. But March and April, due to intermittent rains happening all across the country, the season was not so good. In fact, we had a little drop in the sales. But May has come, and this heat wave which has come has actually helped us a lot. And we are seeing reasonable growth. Not what we expected, but at least for the month of May, we are seeing a single-digit growth, which we'll see in the air conditioners. And the heat sale is still continuing. The heat is on. So we hope that the sale possibly may get into the first week or midweek of June also.
On Mr. Kumar, and would you concur with that after a tough few months, the demand has considerably picked up, or has it been consistent for you?
So, morning everyone, and what Nilesh is saying is absolutely a very good reflection of how the season has built up. In February, it was one of the warmest Februaries in recent decades. So the season was building up well, but February and March across the country, barring select pockets in the country in the east, March and April, I meant, they went a bit on the back foot with occasional rains coming in, cloudy weather, and all that. But from the beginning of May, we are also seeing a sustained pull in the demand, as we heard just on 80 now also. The entire region in the north and northwest, we are seeing temperatures consistently crossing 40 degrees and above. So that's something that is helping all kind of cooling products. I'm sure it's pushing up the sales for air coolers, air conditioners, refrigerators, all the categories related to cooling.
Yeah, and that's precisely, Amit, what I wanted to talk about, because you have a 50% market share in coolers, right? If I'm correct here. Tell me what the dealer sentiment has been so far.
The dealer sentiment has been what I will call a bit on a roller coaster ride. As you said, the season was building up well. In February, most of our channel partners stocked up in anticipation of a strong, consistent summer. The sentiments again went through ups and downs in the months of March and April. April, for example, however, in the east of the country, we were running stockouts, and then it so happened that these dealers were getting worried. It's only around early May when we started seeing the demand again picking up. And as we speak right now, dealers are expecting a good run over the next month or so. And we are also upbeat that end of the season, we may sort of be able to put together the numbers back on the board, which had taken a bit of a run rate loss in the last month.
Right. Nilesh, tell me what segments are doing well, and do you sense at all that the consumer is getting price conscious and down trading?
So one thing is there, what we have seen in our industry, the consumers are not getting price conscious, nor are they down trading across categories, irrespective of summer or otherwise. And I'll tell you, primarily, I've been telling this always, primarily the reason is EMI. People are buying only in installments. So when you buy in EMI, it doesn't matter that if the EMI is slightly 10% more per month also, it will not pinch the pocket, number one. Number two, what has happened is COVID has made a structural shift in the consumer thought process. Because when they were at home and they were using all appliances and electronics, they realized that in future in life, we will never compromise on this. Whether it's a television, which we need a bigger size, or whether it's an air conditioner where we need to have an inverter and of a higher rating, because the usage is more on the usage is much more than normal. So what we have seen is across the board, like the inverter ACs are going, not only inverter ACs, but even in inverter, a lot of people are opting only for 5 stars and 3 stars. So we are not seeing any down trading at all. On the contrary, if anything is happening, it's on the up trading side only.
All right. Nilesh, what's the outlook in terms of the tier 2 and 3 cities? What kind of demand are you seeing shaping up there?
So although we are not much present in tier 2 and tier 3 cities, but whatever I've gathered from the brands, it seems the demand is robust in those cities as well. In fact, some of the categories, people say that tier 2 and tier 3 are doing better, like televisions and mobiles. They are doing much better than even this. And I'm sure Symphony would agree. I think the coolers must be doing much more in tier 2, tier 3 cities than in the metros, where I think focus on air conditioning is much more.
Amit, what about the inflation concerns? Has the company been able to pass the full inflation, or will you be looking at some price hikes in the portfolio?
We have price hikes for this season, and that's the nuanced strategy that we follow for every season. The answer to your question lies broadly in two parts. Actually, one aspect is, have we taken price rises? Yes, we have taken price rises, and in select products, the price rises have matched the kind of cost increase that we have had over the past few years. However, there are also, overall, if you look at and compare versus the pre-COVID costs for plastics, for metals, and so on, the full extent of cost increase is yet to be built into the prices that we have passed on to the market. So versus last year, prices are up. Versus pre-COVID, the prices are yet to take some more sort of upgrade to meet the margins that we had pre-COVID.
Okay. What about you then? Just wanted to understand, Mr. Gupta, as to what the outlook is in terms of the pricing strategy. Is there some discounting or attractive offers, or have there been across the board price hikes, especially for this category?
So this year, there hasn't been much of a price hike. Whatever was to happen had happened pre-season only. And as far as discounts is concerned, So our industry is a very unique industry where if you see throughout the year, there's some discount, some form of discounting in one way or the other. And major form of discounting is in the buyback offers. Then EMIs are the biggest discount pullers. See, people, consumers may not realize that EMI is a discount, but whenever a brand and the retailer ties up with the bank and gives a zero down payment and increases the tenor, that is basically indirect discounting because the consumer is not paying any interest, but the interest is borne together by the brand as well as the retailer. So I think discounting is the norm in our industry, and that's why we are seeing a growth in this industry. So consumers have the best of both the worlds, good products as well as good discounts, always.
So, Amit, give us a sense as to what the outlook is, given the fact that consumer sentiment, you did speak about, demand initially being a bit all over the place, unseasonal rain, summer heat waves, etc. What exactly is the consumer sentiment indicating on ground?
On ground, and I would maybe take a step back from where Nileshji left that discussion around the tier 2 and tier 3 cities. Overall, if we consider the hinterland and the non-metros also, the consumer sentiment is pretty robust. As we speak at this point in time, if I compare versus last year, the total volumes, owing to particular drop in April, the total volumes for cooling products are less than what we had seen last year. That said, we do anticipate that full season, the market would be at about 12 to 15% growth versus the last year. So that's our sort of projection as we see the growth and the opportunities in the market. Overall, the consumer sentiment, coming back to that, it seems pretty robust. And like Nileshji also mentioned, we do see consumers upgrading to products which offer better features, which offer, let's say in our case, larger tank capacities, newer models. So that's something that we are seeing, and hence the consumer seems to be in the right space.
Right. Okay, Amit, Nilesh, both of you, thank you so much for taking the time out and telling us, or rather helping us understand whether this heat wave is also leading to more product sales or not. Okay, on that note, we're going to slip into a very quick break. Just look out for the Adani group of names because they're once again for a third consecutive session seeing a mammoth move. Adani Enterprises holding up 10%. It's a 6% dash on the futures for Adani Ports. Ambuja Cement as well scaling higher by 2.25% as we speak. Within the Nifty 50, it's Bajaj Finance, BPCL after its numbers, and Infosys and Wipro, which are actually taking the lead. We'll take a very quick break. Lots more management chat on the other side.
Welcome back. Let's connect with VS Money, who's Executive Director and Global Chief Financial Officer at Glenmark Pharmaceuticals, to discuss their quarterly performance gone by. Thank you so much for taking time out. Now, to begin with, your US business has seen a good jump on a sequential as well as on a year-on-year basis. What is the outlook in terms of pricing pressure on the base portfolio, and what kind of growth do you envisage for your US business?
Good morning, everybody. Thank you for inviting me to your channel. So our US business has done quite well in the last 2 quarters. We've seen a turnover in excess of about 100 million. Last quarter, we did about 104 million. I mean, and these are all, I mean, we had a number of good launches in the US. We also filed a number of almost 8 products, and we also have had approvals of almost 10. So I think based on these, we see a reasonable growth, at least a mid-single digit kind of growth. In terms of the pricing pressure, obviously the US market, the pricing pressures are always there, and we are looking, I mean, we've seen about a mid-single digit kind of a pricing pressure, little lower than in the past quarters. But all in all, we feel there is a decent momentum in the US business, and going forward, we see it doing better.
Okay, so what is the outlook then, given this optimistic outlook in terms of your EBITDA margins? Can it cross that 19% mark versus what we saw, last year at about 18%? And what will be the drivers that will push your margins?
Yeah, sure. So first and foremost, at the outset, the Q4 was a decent quarter in terms of our, sales growth. We did about 3,370 crores and our almost 11.7% growth, and an EBITDA margin of almost 17.9% at 605. I think the coming year we are quite optimistic about touching about a 19 to 20%. based on a couple of things. One obviously is we expect the revenue to grow at about 10 to 11%. So that's key momentum. Secondly, we are also looking at pruning down our R&D cost a little more, so bringing it down to around 8.5%. Besides, also working on improving our gross margins also, because some of the cross pressures are a little lower, as well as obviously working on our cost side. So all this together with a decent growth in revenue should ensure that we should be closer to the 19 to 20% that we have guided the street.
Sure. Mr. Mani, also wanted to understand, because, time and time again that we've spoken with you, you've always said that the focus is on reducing debt levels. By what amount can we see this coming down in FY24? And what plans regarding getting net debt free?
So we had given a plan that we should be net debt free in about 26, 3 years from today. So obviously, with the robust growth that we are planning, 10 to 11%, and last quarter was obviously vindicated what we are thinking. So looking at the robust growth, and also on the back of the fact that we had some remediation costs, etc. last year, those should be behind us, as well as looking at our innovation side, Iconos, where we have been pruning some costs, and also looking at partnership, etc. Taking all these into together, and with a good growth that we are looking at, and some of our products doing well, I think we should be in a position to kind of looking at a zero net debt by 26. Today we are having a net debt of about 2,900 odd crores. I think with the EBITDA which we had current year of almost 2,300, a little more than one time, I think 3 years is a good time to look at a zero net debt.
Sure. What's been the reason for the sharp increase that you've seen in both inventory as well as debtor days? And this is both sequentially as well as on a year-on-year comparable basis?
So obviously, inventory last year was a little up, as well as in the current year. As you know, across the chain, there have always been some challenges over the last 1.5 years because of the inventory situation. You had various reasons as to why. The reason was that going forward, the supply chain looks at more of safety than to look at just the efficiency. So obviously, we need to have proper inventory so that we can service the market. So that is one reason why the inventories have gone up. So they've gone up about 8-9 days. I think we broadly will be here. As far as the debtor goes, obviously this year, or especially in the second half, there has been a sharp rise, because the growth has come more in the markets where there are where the credit periods are high. So in markets like rest of the world, EU, etc., they've been higher. India has been a little lower, and also currency also had a play in that. Because of the restatement of debtors. So I think going forward in the coming couple of quarters, we see it come off at least by 10 to 15 days. So we should be closer to 100 days. And this is primarily one of the reasons why there was a little sharp uptick in our debt as well in the last quarter. I think in the next couple of quarters, we see it kind of being more receding down.
All right, moving away from the numbers, what's the reason behind registering a new subsidiary, Glenmark Healthcare? What is your plan over here?
Yeah, sure. See, as I just alluded to the fact that we are looking at a robust growth of about 10 to 11%, we'll obviously need capacities. So we are, evaluating an option of putting a manufacturing company. So that is why we are looking at 100% subsidiary below Glenmark Pharmaceuticals. So we have registered the subsidiary. We will evaluate and decide whether we go forward or what we plan.
Okay, fair enough. But what kind of growth potential are you looking at? What is the game plan for the long haul here for Glenmark Health?
So we are looking at least a 10 to 11% growth over the next couple of years. And we obviously every year we work on a long range plan. So looking at the way if you look at it, the way we've been growing in our key therapy areas, whether it is respiratory or dermatology or oncology or some of the, like cardio, etc. So across the board, we've been doing quite well. So I think taking that, we feel that we will definitely need more capacities, and whether we put it in the existing sites or we look at a new company to do that is something we evaluate. But end of the day, I think as you can see that we are at about 13,000. So at a 10% growth, we should be doing well over the next few years. So that's the reason why we want to put up we are looking at capacities.
One very quickly question, Mr. Money, and if you can clarify on that, because I see that the India business has seen a decline on a sequential basis. What is the growth that you're targeting for this fiscal for your India business in particular?
Okay, let me respond to this in two ways. One is obviously, if you look at IQVIA MAT, even March 23, we've been growing at about 12.3%, and we expect to grow at about 13% odd in the coming year as well. So I think as far as the base business goes, the RX we're doing quite well. I don't see any, sort of any concerns there. It's just that, when compared to year, if you look at it, we obviously divested some non-core brands. We also had the impact of NLEM like everybody else in the industry. And obviously also the fact that, we also have been looking at some of our hospital and oncology products where we could prune down a bit. So taking all this into concern, that is the reason why it looks like a lower growth. But I think the underlying business is doing quite well. And also, just to add, we also had during the year, we had some COVID product sales returns also. So that is behind us. So I think these, extraordinary items should be not there. So therefore, I think the underlying growth should be decent.
Okay, good to hear that, Mr. Money. Great to have you today on ET Now. Thank you so much for taking the time out and speaking with us today.
Thank you very much. Thank you.
Okay, that's the word coming in from Glenmark Pharma. And let's just quickly bring up the stock price up for you, holding solid by a good 1% as we speak right now. As is PB Fintech after the turnaround that they've posted in their quarter gone by. In fact, let's hear out what the management is saying. They're sounding pretty hopeful about turning PAT positive this fiscal. Hear out what they told analysts on their conference call.
March would have some contribution to it because March was a bit of an exceptional month from a savings business perspective, where certain tax advantages led to higher sales of the savings products than usual. Our CSAT continues to stay at 88%. Our existing business did 504 crores for Q4, and out of this, credit-linked revenue was 120 crores. The credit business continues to grow quite decently and has been EBITDA positive now since December 2022. While we have grown, our losses have come down. So if you recollect, our new initiative losses had peaked at 90 crores. They are down to 36 crores now. PB Partners, our agency aggregator platform, continues to lead the market in scale and efficiency of operations. It has the highest proportion of non-motor business, now 34%. And is presently in 15,000 PIN codes in India. Our UAE business has grown 2.7x. So essentially, new initiatives continue to do well, continue to scale well. We are fairly hopeful of having a positive PAT in our current year, which is 2023-24.
All right, that's the management of PB Fintech in their conference call. But as we take a break, we at the Times Network are back with the flagship event, the India Economic Conclave. It's known to set the stage for driving India's economic agenda. And as we move forward on the path of integrated, equitable development, which is all-inclusive, all-pervasive, universal, and one that strengthens not just the Indian economy, but the global one as well. To pursue this agenda, the theme for this year, India, the emerging third superpower. IEC is going to feature some of the biggest voices from politics to global markets to the economy and the corporate world. So get ready to catch the action right here on the Times Network. Back with first trades right here on ET Now. It's holding out by 0.5% on the frontline index. Just want to check in as well within the broader universe what is showing you momentum this morning. And what's scaling up on the screens right now is, of course, the Adani group of stocks. But other than that, Capri Global, 6% on that candidate. We flagged off MCX earlier this morning. That stock is at about 1393. ITI is actually a buzz in trade. You've got something like a Bandhan Bank, which is up about 3.7%. Shree Cement, another smart mover, and Dilip Bilkon is on the gainers radar. But let's move on then. Srishant Challa, who's the managing director at CCL Products, joins in right now on the show here to discuss the outlook on the overall business, as well as we talk about what's brewing when it comes to Robusta coffee prices, which are at a 12-year high. And I think I'm going to begin with that, a 12-year high, and that's largely on concerns of the tight supply. What is the on-ground situation in terms of the supply from Vietnam and Brazilian Robusta exports?
So, based on the crop cycle, we've seen that the Brazil crop will come in the next 2 months from now. And as of now, in Vietnam, there are a lot of defaults which are taking place, which is actually causing this steep price increase. So there are a lot of funds that have taken a position in coffee, and there's an artificial demand that has been created. And because of this, with the defaults taking place, it's a spiral that has started right now, which is causing this artificial increase in prices. To be frank, we don't feel that this is sustainable. Once the new Brazil crop comes as well, there should be a steep correction that takes place.
Okay, fair enough. So don't believe that it's sustainable. But the other big factor is the El Nino situation. And there's a possibility of a cut in global coffee production. What are your thoughts on this? And if the prices increase further, would that change in the coffee contract prices?
So going forward, it depends on which region we are looking at. As of now, the Indonesian crop is also coming into the market. There is a reduction that is there in Vietnam and Indonesia, but it's to the extent of maybe around 15% or so. Brazil, we're actually expecting a very good crop. And this year, I think in the next 2 months, we will get clarity. Brazil being the largest producer in the world, that was going to determine how the coffee prices are going to pan out in the near future.
So as a company, Srishant, how is it that you are protecting yourself from the impact of high prices, and how much coffee inventory do you currently have?
So we work on a cost plus model. So we act as a converter. So anytime a customer comes to us with a certain contract, we cover the raw material on a back-to-back basis. So we don't take any risk with respect to the coffee prices moving up or down. We advise our customers accordingly. If a customer is well covered for the next couple of months, we would guide them saying that wait for another 2-3 months before you confirm more volumes. Typically, we have orders in place at least 1 year in advance. And because we work with large trading houses, we don't have any defaults that take place at our end. So our partners who are supplying the coffee to us, they end up supplying, even if they have to buy in the market at a higher price, they buy the coffee and ensure that they supply to us at the contracted price. We don't take that risk at our end at all. That's how we are protected.
And is that the case with your margins as well, or does it impact your margins in any way?
No, it doesn't. Because we do it on a cost plus basis, our margins also will not be impacted in any way. The only thing is the top line is something that is going to get impacted, not for the contracts that are in place, but if we do any business now for the future, there will be a larger top line that we'll have to factor in.
And let's discuss your Q4 earnings as well. The FY23 volume growth was at 20%. The guidance was given for FY24 for volume target of 15 to 20%. Are you on track, or will there be a decline in volumes?
We're looking at around 20% this year as well. So last year also, we have given a similar volume guidance. I think we ended up with about 21.8% or something like that. The EBITDA growth also has been proportionate. This year also, we've given a similar guidance of 20% plus or minus maybe 2%. So we are on track for that. We already have our contracts in place for the current financial year. We've already started selling for the next financial year as well.
Okay, and what is the outlook then in terms of your operating cash flows? That has been a bit of a concern. When do you think that we can see the full potential for CapEx kicking in?
So we've already come online in Vietnam with respect to our expanded capacity. We are now at 30,000 tons in Vietnam. And there's another expansion that we're doing in Vietnam for freeze-dried, which will come online next year. So our free cash flows are restricted right now because we are optimally utilizing our cash flows at this point in time. And we don't have any spare cash that we are leaving idle at any point in time. We are on this expansion spree, so we are looking at the next at least couple of years where this free cash flow is going to be in a similar range as it is now.
Appreciate your time. Thank you for joining in and sharing with us a view on how things are shaping up, the outlook on your pricing trends as well. That's CCL saying that as of now, 20% volume growth for FY24 is expected. Margins will not be impacted on the back of coffee prices. And as of now, they are expecting a sharp correction in prices post the Brazil crop. That's CCL products for you, down about 0.6%. From one management voice to another, then, let's focus in on Route Mobile and talk about the healthy revenue growth that they have clocked in and what the outlook is when it comes to their guidance. Rajdeep Gupta is the founder and group CEO at Route Mobile. And I'm going to get straight to it, Mr. Gupta, because you have guided for that 20% revenue growth for FY24. Are you on track? Will this be purely organic? Are you factoring in some inorganic growth as well, given that you do have over 800 crores of cash on your books?
Hi, good morning. Thank you for having me on your show. Honestly, I think whatever guidance we are giving for this financial year is going to be completely organic. And as we already have over 800 crore cash in our book, but right now we are very focused on integrating all the acquisition which we have done in past. And I think it is very critical for any company who acquires company globally needs to focus on integration. And I think from last few quarters, we are focusing completely on integrating all those companies as a part of one company. And most of the part is already integrated, and I think we are very happy the way the process has moved till today. As of now, I think honestly we don't have anything in our plate to look for an acquisition. But as I already mentioned in past also, we definitely want to grow multiple market, and there are certain markets which we are looking out. We may look for acquisition in few quarters or maybe after a year. But as of now, I think we are all good to build product in-house and focus on all the integration companies which we acquired right now.
So, any clarity in terms of what kind of an acquisition it would be, even though it would be down the line? And, if you could just walk us through any more details on that front?
As I said, acquisition, there are two ways to sit. Like if I really want to go global in a particular market, say like Brazil or in Africa or in Australia kind of thing, probably I would like to acquire a local company who's already based out of there and already serving the local enterprise customer. But I think that is a kind of footprint we want to build in certain market like Australia, Africa, and Brazil. This could be three market where we would look for some acquisition, but as I said, as of now, we are not looking out for any acquisition. It may take some time for even to think about or to find the right asset in future, which we really has the same kind of a DNA what we as a company have, and we want the founders also who wants to stick with us and grow with us, and that kind of mindset is required before we acquire any company. So we are early stage of very early stage to even think about those markets. But yes, as I mentioned, these are the markets where we definitely want to grow our footprint, either organic way or inorganic way.
Rajdeep, two concerns the market has looking at your numbers right now. A, that the FY23 organic growth was about 41%, right? So why the lower revenue growth rate then for FY24? And B, your margin guidance for the full year is also quite flat at about 12.5% to 13%. So, indicating that there is no operating leverage also at play owing to higher revenues.
So I think if you see, we as a company are a platform company, to onboard a customer, I think we don't need to build any kind of additional solution. And if we are serving a OTT player like a Google or a Facebook, and we want to add another country as a part of their delivery connectivity, we really don't need to spend money on that, because as a platform, when the platform is already ready, what we need is just plug and play, and immediately we start getting revenue. The kind of guidance we have given, 20% over 3,500 crore, that's what we're talking about 4,300 crore kind of a revenue. I think we are very bullish and we are always, as I said, like we are conservative. Last year we gave about 70% growth guidance and we did 78%. So I think being conservative is always good to being aggressive. That's what we believe as a company. And I think, what was your second question on cash flow?
That's a point taken, but the other concern that the street has been having, that the cash conversion has been a bit slower. What are you doing to improve that in terms of the cash conversion, and also if you can give us an update on your market share in India?
You need to also understand we have a very large deals, like in past, and we are already talking with certain operator in Asia and other in Africa also. There are certain operator where we have given a security deposit in the tune of over 100 crore in last quarter, and that is like a prepaid kind of thing, and that has actually impacted a little bit of our cash flow. But henceforth, we are going to, and I think we are live with the Mobitel Sri Lanka on 21st of May. That revenue is now going to be part of our overall revenue in coming quarters, and where I don't need to pay any single penny to the operator. That means that our cash flow is definitely going to grow in next 2 quarters, and I think by Q3 you can see a drastic growth in our cash flow. In terms of India market, like as I mentioned before also, India is a very fragmented market because there are so many resellers, small resellers, tier 2 reseller and tier 1 aggregators. Just to quantify the percentage is a very tough thing, but honestly, as I speak, in terms of international termination to India, is about 50% market share we have, and domestic to domestic termination, I think over 20% market share we have as of now.
Okay, thank you so much for joining us today and talking to us about the growth prospects. So that's the management of Route Mobile talking about their market share, the growth outlook of the company, and how the margins are likely to pan out. But time now to move to our chart busters segment, wherein our technical experts bring out the big ideas and the big trends that they're spotting as far as the technical chart goes. First, Kunal, tell us, is there any stock on your radar? Today, you're looking for the glittering gold.
I think it's gold prices on the dollar terms, which is very interesting because over the last 2-3 years, we've seen that gold in rupee terms has moved from 50,000, 55,000 to now 60,000 plus levels and comfortably sitting at the 60,000 mark. But then the dollar charts for gold is interesting because we formed what we call it as classically triple top pattern for gold on the dollar term charts. This 2070 was the level which was hit post-COVID in the year 2020. In dollar terms for the gold prices, this was in 2022 when gold prices hit 2070 approximately, and the recent high which was made I think 2 or 3 weeks back for gold prices was around $2,072, which means that there's this massive trend line resistance at the $2,070 per barrel mark, $2,072 mark for gold prices, and we are also now getting into that phase of rising trend line, which means possibly we may correct back towards 1900 levels for gold over the very near term, and post that is where I would expect the breakout to happen. And if that is a strong case of a breakout, then earlier like in 2010, 2001, gold prices could get into a multi-year of uptrend. So it's a temporary phase of a pause for gold prices. Hopefully the prices can come back another $50 in dollar terms, but I think post the breakout about $2,072, I think we can expect a much more bigger up move and possibly a multi-year uptrend coming back into gold.
Okay, multi-year uptrend. That's what Kunal is betting on when it comes to the gold prices. But Naresh, what about you? What are you spotting for us on the charts today?
So that's a chart for Bajaj Consumer. Now, if you look at the stock saw a deep correction over the last 1 year, 1.5, 2 years. It has been in a downtrend, but finally after 1 year of consolidation, a base building formation, the stock has bottomed out. The stock went back almost back to COVID lows and then recovered from those areas. Now 180 has been a resistance for the stock for the last 1 year. The last attempt was in April of 22, recently in December 22, and now in May also after the quarterly numbers, the stock saw a spike to 180. After that, consolidated for the next 3 weeks. Volumes have increased in this move. That makes it more convincing that the breakout could last. And also, this is one of the largest volumes over a 1 month period compared to the last 1 year. So a clean cup and handle breakout here. The breakout is done. Expecting a move towards 220 to 250 levels. A stop loss to be kept at 175.
All right, there you have it. Bajaj Consumer and the chart of gold. Those are the chart buster calls. But let's find out some individual stock recommendations as well. And Kunal, what is it that you're going with today?
So I'm betting on Bank of Baroda as the first stock from the PSU banking lot. Suggesting a buy with 190 as a target. Stop loss at 177. MCX is the second stock. Very good recovery in the last 2 days. On the spot levels, it's at 1,380 approximately. So would suggest a buy with 1,600 as a positioning target. Stop loss at 1288.
Okay, there you have it. That's what Kunal is looking at. But let's find out what Naresh's recommendations are. And there's also a banking stock on your radar, Naresh.
Yeah, so first is a buy on HCL Tech. The stock continues to look interesting, setting up for a bigger breakout about 1150. Expecting that to take place over a period of time. Stop loss at 1090 and a target price of 1250. The banking name is IndusInd Bank. The stock is trying to make a 3-year breakout. 1250, 1270 has been a resistance multiple times. Back at that price today. Once it breaks out, it should be a leadership move, wherein it could go towards 1600 in the medium term. Also, short term target would be 1400. Stop loss now at 1200.
Okay, Kunal, Naresh, we'll see you again later in the day. And one of the best performing stocks in the MFI space has clearly been Spandana Spurti. And that could see a big block deal or a series of blocks in the next few months. As per sources, my colleague Ajay Sharma gets us exclusive details and on the buzz on this one.
Well, that's correct. We are picking up from our sources that there could be, start of a couple of very large block deals which could happen in Spandana Spurti. And this is actually the former MD of Spandana Spurti, Padmaja Reddy, is considering selling her residual stake via block deals. Well, the institutional interest is very high in this stock. So, they are asking for one single block. But what we understand from our sources that Padmaja Reddy may be considering selling it in multiple blocks of 2 to 3 blocks, because they have almost 14.5% stake residual in Spandana Spurti. You remember, Spandana Spurti is actually Kedara backed, and Kedara Capital is the largest shareholder there. There was a change of guard, the change of management when the founder and former MD's term ended, and there was a new management had taken over the leadership position. The former MD Padmaja Reddy still have 14.5% in the company, though she doesn't is not in the executive capacity in the company anymore. She is right now busy building her own company, a new company, Kirtana Financials, and this proceeds of this block deals will be going to fund the progress of that particular NBFC, which is a women-centric NBFC she is setting up. This 14.5% stake in Spandana is valued at close to 700 crore. And we understand that via sources that ICICI Securities has been appointed as the banker to look for prospective investors. If you look at the last Q4 results, the company has really turned around very smartly, and very good strong set of numbers came in. So, there is a lot of interest by funds, but funds are asking for a single block. And what we understand that because Padmaja Reddy though is interested in funding her own venture now via this money, is not, there is no fire exit over there. So, the likelihood of very deep discount is not there. That is what we are gathering. So, we spoke to the management, the current management. They refused to comment. They said we don't comment on market speculation. We even sent out mails and messages to Padmaja Reddy regarding this, which did not get any response. But we know that there is this block which is there in the market, seeing good response, but most of the players want one full block. Padmaja Reddy may actually go ahead and sell it in tranches without any deep discount. So, watch out for Spandana Spurti on this news of ours.
Okay, so we'll watch out for Spandana Spurti on account of that, but watch out for the big event which is lined up at Times Network as well. We at Times Network are back with a flagship event, India Economic Conclave, which is known to set the stage for driving India's economic agenda as we move forward on the path of integrated, equitable development, which is all-inclusive, all-pervasive, universal, and one that strengthens not only the Indian economy but the global one as well. To pursue this agenda, the theme for this year is India, the emerging third superpower. IEC will feature the biggest voices from politics, global markets, economy and corporate arena. So get ready to catch all the action right here on Times Network.